Hello, thank you for joining our webinar series hosted by Creekmore Realty Group at the coast of North Carolina in the Wilmington, Brunswick County area. Today, I'm joined with Vince Bakke with Intercoastal Mortgage, and he is also in my area. The topic of this webinar, I hope you'll find it very informational. It's about buying a home while transitioning from employed to retired. So many of the people that we work with haven't bought a home in 20 years. The rules and guidelines have changed. So hopefully this will help you to know what to expect and what to plan for, and answer some questions when you're going to purchase property here anywhere across the country. So Vince Bakke is a seasoned loan officer. He's been in the industry for about 20 years. He's with Intercoastal Mortgage. Again, he's in my area. He helps people buy existing property as well as new construction. And there's rules and regulations on both of those that are a little bit different. So he's here to help us answer some of those questions. So Vince, thanks for joining us. And we look forward to hearing some of your questions or answers.
Thank you, Chris. Thank you for inviting me. Appreciate that.
Yeah. So let's get into it. What kind of income will qualify for a loan, considering that we are mostly talking about retirees?
Sure. As always, W-2 income qualifies. That's if you're working or at the end of your work life. But of course, self-employment income works if you are have a company, and maybe you're even moving the company here while you're still keeping it active. That income will work. Social Security income works, of course. Pension income, annuities, they work. Withdrawals from retirement accounts, asset depletions, and then dividends. We can use average dividends over a period of 2 years if you have a substantial amount of money generating dividends. So those are mostly the categories that we use today to qualify people.
Okay, so you touched on asset depletion and withdrawals. So this is a I guess a means for qualifying for the loan. Yes. That a lot of people are not aware of, that because I don't have a job anymore. So how am I going to use my assets to qualify for the loan? So talk a little bit about the difference between asset depletion, what that is, and withdrawal from a pension.
Sure. Many of the clients that we run into have stopped working, do not have work income, haven't started drawing Social Security. So we have to find a way to qualify them based on their assets or their 401ks. So one, we can set up a withdrawal out of their 401ks. They may not need the money right now, but we need the money to qualify them. So if they have a reasonable amount of money in 401k, we can set up a monthly withdrawal and then qualify them on that withdrawal of funds that we need to get their debt ratios in line to qualify them. Or we can, if they have a substantial amount of money in legitimate retirement accounts, we can use a mathematical calculation called asset depletions, where we never really touch the money. But for example, $1 million in legitimate retirement money would generate about $2,916 in income on paper. So we never have to actually touch the money. We just make a calculation. So that's the difference between the two. And if you have both, it's very flexible. We can talk back and forth and figure out what works best for each individual borrower.
Okay, so let's talk about a real case scenario. Okay, so I'm helping a couple buy home or to build a home. So we've picked out the land. We're in the construction contract phase with the builder. And let's just say that the build cost of the home is $450,000. So we've signed a contract, okay? And the builder says, we want you to qualify for the loan within 15 days. So we go to you start the loan process, and whoops, I need a little bit more income. I didn't realize I needed more income, but to qualify for the loan, I need a little bit more income. So you recommend in this scenario, you recommend doing a withdrawal from a pension.
Yes.
So is that going to talk about the timing of that withdrawal, and does it delay the start of the construction?
It shouldn't, Chris. It's usually pretty easy to work with. So let's say our client has their investments with Fidelity. I'm just making this up. And let's say they're getting $3,000 a month, and we need $5,000 a month in order to qualify them. They would basically call their asset manager and say, listen, increase my monthly withdrawal from 3 to 5, send me the extra 2 immediately, and the next one schedule, or the next one's thereon scheduled for the 1st of every month, and send me a letter saying that I've requested that kind of money. And usually that will not slow down the process of getting them qualified within 30 to 45 days and getting the loan closed in that period of time. It's worked pretty seamlessly. Again, as long as the asset manager is cooperative in getting that done, and they usually are, because they understand that kind of thing happens all the time, we can get it done. So it's not usually a big issue. And then of course the only liability to the client is that you're going to have a little taxes on a little more money withdrawn. But once we complete the entire loan process, you can shut the thing down, and you don't have to spend the money. You can reinvest it again, but we just need to see it coming out.
Okay. All right. That makes sense. And I've had quite a few people use that, and their concern is, well, gosh, I don't want to touch my pension. Well, it's only a very temporary thing. And as you indicated, it's very minor tax implication.
Yes. Yes.
Okay. All right. So in different regions of the world, a lot of builders will carry the cost of the construction of the home. Now that is true here in Brunswick County as well. However, there are a lot of very popular builders who do not carry the cost of the construction and require a construction permanent loan. So we call it a CP loan. So can you explain that type of loan and a little bit more of the timing of that?
Sure, Chris. Our company, and everybody does it slightly different, but our company does construction and end loans in 2 different loans. Our construction loan is very much like a home equity loan. You only pay interest on the money that's withdrawn and wired to the builder. So, and again, there's no interest until the money is being drawn out. And at the end, when we get close to the end, we lock in whatever permanent mortgage you want. And then the advantage to us, of course, you can also change the size. You can lower the value, and I'll explain that in a minute, and lock in any size of permanent mortgage you want at the end. We just qualify you in the beginning for the same size as the construction loan. So if you're pulling a $500,000 construction loan, we're going to qualify you for a $500,000 end loan, just so we know we can get you out of that loan. But with the advantage, one of the advantages to doing it with us and doing the 2 loan scenario, it's obvious it's not double the cost, but the advantage is you're going to sell that house and you may not want a $500,000 end loan. You may want a $100,000 end loan or $200,000 end loan. With us, that's very simple. With the one-time close, which are offered down here, that's not possible because you already finished your loan. So you're stuck with that loan. So
So the only way to reduce the cost of the loan is to just apply for a new loan.
refinance and go through the whole thing again.
Yeah, which will be more costs. And most of the people I work with want to take a chunk of the house that they sold and put it towards a loan. So that's a big advantage of working with Intracoastal Mortgage. So, so if I have a house, and I want to sell that house, do I need to sell that house before I start the loan process?
Okay, so now we will try to qualify you with that house. And if your intentions are to sell that house, our company works a little different. We do a lot of construction loans, and we do deal with a lot of people in transition. So if your intentions are to sell the house and you're very well qualified, we will not count the debt that's currently on that house against you if your ratios are a little tight. With us, we can overlook it. So if you have a mortgage on that house, fine, we'll not count it. We usually count mortgage, taxes, and insurance. If all those payments are rolled into one, there's a possibility we'll not count it. If you don't have a mortgage, you still have debt on that house with taxes and insurance. And again, if your intentions are to sell it and you give us a letter and to file it, you will sell that. We won't count that. So that's very helpful on people that are worried about qualifying for a home down here while they currently have a home somewhere else. You know, again, with reduced income, retirement income, maybe your income isn't as high as it used to be where you could qualify for anything. So this might be real helpful to go the path of doing a construction loan with us.
So I just saw a question from Marcy in Toledo, Ohio. So her question was, do we need to show the listing agreement? Or is that even
maybe
required?
not necessarily. We would take their word for the fact that they're building a permanent residence down here, giving us a short 1 or 2 sentence letter in the file, and we'll just make sure they're credit worthy and the house that they're in is in a position to sell in an area where it's going to sell, so that we feel fairly confident that the deal is a good deal. So I mean, it's got to be good for us as well, but we want to try to help the client as much as we can. So we're bending the rules a little bit in order to qualify people. So
okay. So how can your bank do that when your lenders, when other lenders don't? That's just their requirements?
well, you know, we set up our own construction programs, and for some in some aspects, most of the lenders, the construction programs aren't national programs. Every bank and company does them slightly different. So you're guaranteeing the money sort of on your own rules a little bit. And we do lots of construction loans here in the Mid-Atlantic region, a lot of them. And we're one of the powerhouses. And that's the way, you know, we find it works for us. We don't get very many defaults on doing mortgages, and we're fairly comfortable with the customer base we deal with. So we're comfortable in doing that.
Okay. All right. Awesome. So on the construction, because COVID and the way pricing of lumber and other things have happened, let's say I have a house that the cost to build the house is $400,000, and I'm in a neighborhood where there hasn't been a whole lot of homes that have started, but I was lucky enough to find a vacant home site to build. And there may not be as many sales in that neighborhood to justify the cost of new construction in an older neighborhood. So what if the appraisal doesn't come in exactly, the cost of the construction appraisal doesn't come in exactly in matching with the build contract?
Well, sure. I mean, and this does happen a little bit because when the appraisers come in, they're appraising from a set of plans and basically a piece of dirt, and they're trying to figure out what the value of the home is. So occasionally the new homes do come in a little low. So one of the advantages with us is that on primary homes, we'll lend up to 95% of the value of the land and the house combined. So your intentions may be to have an 80% loan with 20% down in land and equity. So that's one category and that's one interest rate. But, you know, if it comes in a little off, you know, we can always bump it up to the next category. Again, you're only paying interest only for a short period of time. It's not like you're stuck in this deal for 30 years. So if the rate goes up a little bit, it's not the end of the world because it's not for a long period of time and it's only on money withdrawn and wired to the builder. So if it bumps all the way up to 95%, and we have an issue, then you may have to come to the table with more money. Or if you're bent on keeping it at 80%, you might have to bring a little more funds into the transaction. But we have a lot of leeway on that because we'll go up to 95%, which most of the lenders around here will not do.
Okay, all right, that's very helpful.
On construction.
Yes. Okay, so on the construction, so let's say I'm working with what we call a portfolio builder. So he has 5, 10, 15 floor plans. We walk into a model, we say, we like that floor plan, build that. And then the builder, we sign a base contract, and then we go to their design center and we select what may be upgrades. So let's say we upgraded from quartz to granite, and that costs us $2,000. But it is written in the contract, the final contract. Do I still have to pay those upgrades out of pocket?
No, Chris. We'll start the loan process off the plan, specs, and contract with all the upgrades built into it. If after the fact, if after we close the construction loan, you come back and say, you know, I don't like tile in the bathroom, I want stainless steel or something like that, and all of a sudden it builds another $2,000 or $3,000, then generally you'll pay for that out of pocket. There is a possibility we can redo the construction loan and raise it during the process. It's not free. It's not terribly expensive. It's a little bit of paperwork. They have to actually re-record the deed at a higher dollar amount, but it's possible. But generally we tell the people, if you have the wherewithal, just pay for anything after we close the construction loan. Any upgrades after the fact, pay for them cash. It's easy.
If it's in the final contract that is submitted over to your office, then we don't have to pay out of pocket.
You do not, and we would pass that along to the appraiser, and they would be appraising the house with the upgrades in it, because they're going to get the plans, specs, and contract.
So Intracoastal Mortgage, they will work with you on existing properties, existing homes. They will work with you on construction to perm, with two big advantages with the company with Vince is with, in that they can set the debt of your existing house aside and qualify you for that. And also they give you the opportunity to get a two-time closing, if you will, on your construction loan, but that allows you to put your house on the market after you enter a contract with the builder, sell your house, and then if you have $350,000 in equity, you can put it towards a $500,000 build and reduce that debt. You can't do that if you have a one-time closing that the other lenders offer.
Right,
So,
and Chris, the point is that a two-time close is not two times the cost. The bank fees on the second loan are a few $100s. Literally, very little is repeated. I just want to throw that in.
That's important to know. Thank you for that. And so with that, what other tips, do's and don'ts would you like to share with our viewers?
Okay, so when you enter into the loan process, it's really important to keep an eye on what happens with your credit. So you want to avoid opening up revolving accounts because that has immediate downward pressure on your credit scores. You want to make all payments on time, especially your mortgage payments. If you have to buy a new car, you would want to check with us first. We'll run new debt ratios to make sure that doesn't disrupt anything. But generally, if there's no issue on debt ratios, buying a new car really isn't much of a deal. We just need the paperwork. You to keep all the paperwork. We're going to need it when we get to the end loan. So one last thing is that please maintain 25% balances or less on credit cards. Spread out the debt. Don't go charge any credit cards to the max. If you have a $10,000 line, don't put $8,000 on that credit card, even if you're going to pay it off every month. Keep it down to a quarter or 25%. It's important to watch your credit score. It's very important. So when we get to the end loan, we're going to quote you a rate off of a good high credit.
So let's say this home that I'm going to sell, and I have a home equity line of credit on it, $10,000, whatever it is. Although I owe nothing on it, it's a zero balance. It's an open line of credit. Should I close it?
No, you do not want to close any lines of credit. I mean, of course, if you're selling a car, you're closing a line of credit. That's different. If you have a line of credit on a house or a credit card, do not close anything. You don't have to use it, but don't close it. Closing credit cards also drops your credit score. So we want to make sure that we maintain a good, solid, strong, healthy credit score during the whole period of the build from the start to the finish. We don't want to disrupt credit.
Very good. Anything else that you'd like to share?
Yes, just one thing back on the construction loans that unlike most of the banks down here, if you're a veteran, we will do 100% financing on a VA loan construction to perm. And that's something that most of the other lenders will not do. We'll also do that if you happen to need an FHA loan to qualify. Those are loans with 3.5% down. We will also do a construction loan with that. Those are two unusual circumstances in case you need that kind of financing.
Okay, so that brings up another question. What if I am not ready to start building, but I see a home site, it's $100,000. Does your lender, will they lend on the land itself?
No, we won't lend on land only. We'll lend on land in conjunction with a construction loan. We'll do that. Land only, we usually refer to a local bank here. We have connections with local banks, and we would get you started with that if you want to borrow on the purchase of that. But if you buy it cash or partially cash and do a small loan with it, that does count towards equity in your construction project. So that's part of the deal. That's part of the money or the equity in the project, land value. So it's good.
Okay, so it's part of my down payment.
Yes.
So let's say I bought the land cash outright, or even if I used a home equity line on the existing house.
That's right. That's right.
So that is essentially my down payment for the.
That's your earnest money down on this transaction. Absolutely. Yes.
Awesome. So I've been working with Vince for over 10 years now. He has been extremely helpful and down to earth in explaining things to my clients over the years. Makes the process very simple, and he's very responsive on phone calls and emails. So that's a big reason that I've chosen to work with Vince over the years. So I'd like to thank everyone for joining us on this webinar hosted by Creekmore Realty Group. Please do follow our website, creekmorerealtygroup.com, and also we're on Facebook and Twitter, Instagram, and all that kind of stuff too. So look for other webinars that we will be hosting. And we want to thank you, Vince, for your time. Vince's information is saved on the bottom of this webinar. So please feel free to reach out to Vince at any point in time.
Great. Thank you. Thank you for having me.
Thank you, Vince, very much. And I hope you have a great rest of the day. And everybody else that's on this webinar, thank you for taking the time to log in.